And I just want to get back to Emily on the Hill. I guess it's now official. Yeah.
Scott, yes, it is now official. The senators, they've been here for more than 24 hours, so they voted very quickly. But yes, as we said, 51-50 with J.D. Vance breaking that tie. Now the Trump megabill has passed in the Senate. It now, of course, heads to the House. We have heard from a number of lawmakers there, fiscal hawks, even some more moderate members who have had concerns about the bill. But Mike Johnson is determined to try and get this done, getting a vote on this as soon as tomorrow, and that would get it to the president's desk by July 4th. Now, will that happen? That remains to be seen. It remains to be seen if lawmakers dig in their heels or not on some of their concerns. But certainly a lot of momentum with this Senate passage today, and a lot of the other thing, of course, is that they've made a lot of last-minute changes to the bill. It sounds like that excise tax on solar and wind might be out. And, of course, we're reviewing additional changes to get a better sense of what the Senate just passed. Guys?
All right, Emily, thank you. Emily Wilkins down in the halls of Congress for us following all of that. It's interesting to see the move in the bond market. And I'm just wondering, Josh, I'm just going to make you pivot for a moment to react to all of this as it's developing. Can we put that back up, please, of the 10-year or whatever you had up there, please? There it is. Whether you think the bond vigilantes are going to have the last word here, or at least want to have a little bit of yell before things calm down in the Treasury market.
That could be, and perhaps that's a headwind that we need to think about, and perhaps there will be a day or two where a spike in the 10-year gets the attention of the stock market, and there's a little bit of puke as a result. But I really don't think that that's the main thing. I think the much more powerful trend that's happening right now is the weakness in the dollar. And one of the points I wanted to get to before we went back to Washington is that one of the things powering investor portfolios forward this year is international stock exposure. I haven't been able to say this in a while. I looked at my own 401k yesterday, and I had to refresh the page because I thought there was an error. I'm doing double the performance of the S&P in my retirement account, and the reason why is 40% allocation to international stocks. You're talking about a gigantic asset class that's been a drag year after year after year. We're coming off one of the most incredible spades of performance for international stocks, almost every region. And this is really important for investor psychology. They no longer are just looking at the SPX and saying, all right, a lot of my portfolio is doing well. They're making money all over the place. Through Friday, international stocks were outperforming U.S. stocks by 12.6 percentage points. That's the widest gap in 24 years. 2001 was the last time we saw anything like that. When you look at the effect of the dollar, which I think, again, more important than the bond market at this current moment, if you strip that out, international stocks are still up 11% year to date. So, yes, it's in part a weak U.S. dollar phenomenon, but there is earnings growth all over the place. We talked last week about South Korea. European countries have earnings growth again. It's a miracle. So it's great for investor psychology when they're making money, not just in the U.S., not just in the NASDAQ or the mega caps, but they're making money throughout their portfolio. And that's the case right now. And I think it's a big positive.
Jimmy, it's going to be worthwhile watching that dollar. The move lower to start the year, which is the worst open to a year in decades. There's some talk today questioning whether the dollar move has bottomed. Now you have to pay attention to that. The bond market, do you want to weigh in on what you think now that this bill has at least passed the Senate? Of course, it's going to go back to the House. Don't expect much of a roadblock there, but you never know until it ends up on the president's desk with his signature on it in Sharpie.
Yeah, I mean, there's still a lot of sausage making to be done, as the expression goes. To answer your question directly, the 10-year at 427, it's right there. That's fine. I mean, look, on a day like today, the markets are soft a little bit, but there's a little bit of divergence, a little bit of broadening out. It gives a chance to sit back and say, what really matters here? I'll tell you, the 10-year Treasury at 427, Scott, makes me feel good, makes me feel I can look right past it. I do want the dollar to start coming back. And that leads into where my head is as I can sit back a little bit and look at the broader picture. I'm glad we've got the budget bill getting to a conclusion, but we got to get trade deals done. I don't think any of the four of us have mentioned that yet. We got to get some trade deals done. And I was looking just before you came to me at one of my favorite stocks. You know, it broke my heart to sell General Motors. I had to sell General Motors because of all these trade ramifications. Now I start to think, with the stock up 5% today, that maybe what the market is sussing out is that when we get the rules of the road done in terms of where people are supposed to set up factories, that a company like General Motors can adjust to that and shouldn't be trading at 5 times earnings, that maybe those earnings themselves are depressed and going to be higher than expected and should get a higher multiple. I need to take another look at General Motors, but my point being is that a lot of good things can come together. I don't like where the dollar is, just to answer your question directly. I do like where the 10-year Treasury is. I like that the House and the Senate now have to come together.
Why are you in love with where the 10-year Treasury yield is?
Because it's the sweet spot. It shows that the Treasury market is saying 2 things. We've got growth ahead, but it doesn't look like it's going to be hyperinflationary. It doesn't look like the deficit's going to get more out of control. Nobody likes where the deficit is. But the combination of the deficit impact from this budget bill, granted its final form still needs to take shape, that combination with tariffs looks like it's going to be neutral. That's what the CBO said a couple of weeks ago.
It's also suggestive that the Fed is, Steph, in no rush to do anything, as Chair Powell reiterated today in Portugal. What's interesting, too, Goldman raises their 2025 Fed rate cut forecast to 3 from 1, September, October, and December. And it's because the tariff effects have been smaller than we expected. That's what they say. Those are their exact words. Whether it remains so, we'll see. But Jay Powell's already said, if not for the tariffs, he'd already be cutting rates. So, you know, he's got his finger on the switch, so to speak.
And that was the bright spot from his speech last week, and he reiterated it today, too. So we now just have to wait and see, just like he's waiting and seeing. I think they're behind, Scott. I think they should be doing it, but that's not my call. That's their call. So the point being is, after his comments last week, I thought July was absolutely off the table, but September also likely off the table. And I actually think September is a real possibility now. I don't know if we're going to get 3. But by the way, I don't think we need 3. I think they should be doing it, but I think this economy has been resilient. I mean, 2.5% in GDP, and inflation, it's coming down.
Well, you do get the so-called, you know, the deadline, if you believe that it's a real line, on the tariffs before the next Fed meeting. As well.
Hopefully.
Let's see how it plays out, and whether, you know, even as far-fetched as it might seem to some, if July ends up being live in any way.
I think September 18th is when we'll get the first cut. I like that he gave us some form of guidance last week as it relates to his thought process with inflation. He said, okay, the inflation's going to show up in June and July. I don't think it's going to show up in June and July, actually, and I think that's going to be the reason why they are going to be cutting rates in September, on September 18th. I thought auto sales were interesting. Auto sales representing the clear premise that there was a pull forward in demand, and that obviously has dissipated, and I think the same type of effect will be seen throughout the summer. That's why I'm not expecting an inflation spike.